Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by hitting the subscribe button, and feel free to leave your comments. All right, let's check the analysis.
All right, let's just look strictly at the tape from Tuesday, January 27th, 2026. If you were watching the ticker for TON Holdings, symbol XHLD, you witnessed something, well, something statistically staggering. The stock opened at $1.30. By the time the intraday peak hit, it was trading at $2.90. That is a 123% gain in a single trading session. But honestly, the price action, as violent as it was, isn't even the most startling metric here. It's the volume. We saw 54.11 million shares change hands. Now, to put that into the proper context, you have to remember that following the recent reverse split, the float, the actual tradable supply of shares, is only about 3 million. We are talking about the entire available supply of this company turning over nearly 18 times in a single day.
And that right there is exactly where we need to pause and really consider the implications of that number. A turnover rate of 18 times in one session is not investing. It barely qualifies as trading, in the traditional sense. It's a game of hot potato played at high frequency. You're looking at that volume and seeing a sign of robust interest, of repricing. But when I see XHLD closing back down at $2.54 after that peak, I don't see a repricing event. I see a liquidity trap. This looks like a mechanism designed to lure in retail capital right before a sell the news collapse, specifically engineered around the scarcity of shares.
I understand why you'd frame it that way, especially given the volatility we've seen in this sector. But I think dismissing it as just a trap misses the fundamental shift in the market structure here. We have to acknowledge the immediate catalyst. We are sitting right on the edge of the Deal Flow Discovery Conference starting January 28th. The market is clearly trying to price in a binary outcome. My argument is that this volatility isn't random noise. It is a structural repricing caused by a massive supply-side crisis, a liquidity vacuum colliding with a legitimate catalyst. The market is waking up to the fact that there are simply no shares available to buy.
Or it's a micro-cap squeeze engineered against a backdrop of structural insolvency. We need to be very precise about what we're looking at. This isn't just a volatile stock. This is a company effectively functioning as a dilution engine for its parent company, VCube. So while you see a supply crisis, I see a death spiral financing structure that is just waiting to unleash millions of new shares the moment the price ticks up. The volume isn't demand, it's the churning of a machine preparing to flood the market.
I think that's a bit too cynical regarding the mechanics of play here, though I do respect the caution. Let's look at my position on this supply crisis. The reverse stock split on December 1st, 2025, that 1-for-15 consolidation, was painful, yes. Reverse splits are rarely a sign of health, but we have to look at the mathematical aftermath. It decimated the share count down to that 3 million mark. That created a severe scarcity condition. To use an analogy, imagine a crowded theater where suddenly 14 out of every 15 exits are bricked over. If any panic, or in this case excitement, starts, the crowd has nowhere to go. When you have a float that small, any demand, whether it's speculative or institutional, creates a vertical move because there's simply no liquidity to absorb the orders.
I agree with the physics of the float. But scarcity only matters if the asset is valuable. I mean, if you have the only ticket to a movie that's already over, it doesn't matter how rare it is.
But value is relative to the time frame and the potential. Right now, we have the Deal Flow Conference. The market is buying the rumor. There is valid speculation regarding a strategic alternative, maybe a full buyout or a definitive move regarding the VCube ownership. And significantly, look at the technicals on the chart. The stock is holding above the $2.27 level. That was the price of the December private placement. The fact that we are trading above that tells me the smart money that stepped in a month ago is currently in the green and holding. They aren't liquidating yet. This suggests the market believes there is an asymmetric upside opportunity here, a repricing event that could squeeze shorts who are caught offside in a low supply environment.
That smart money narrative is a very dangerous assumption. Let me come at this from the fundamental reality of the balance sheet. You're talking about technical levels and psychological support. I'm looking at the cash. As of the last report, 10 Holdings had cash reserves of $310,000. That is it, just over $300,000. Their burn rate is estimated around $700,000 a month. They have total debt of over $5 million. This liquidity vacuum you're celebrating is actually just a temporary glitch in what is a long-term liquidation. A company cannot survive on $300K when it burns double that every 30 days.
Distress can drive deal flow, though. That level of cash urgency forces management to make a move. A sale, a merger, something significant.
Distress drives dilution, not necessarily deals. And this is where the Lincoln Park capital argument comes in, and it's crucial we explain this mechanism. The volatility we saw on Tuesday isn't a bug for the company, it's a feature. They have an agreement that allows them to trigger accelerated purchases. When volume spikes to 54 million shares, XHLD can force Lincoln Park to buy stock, which Lincoln Park then immediately sells into the market. This creates a ceiling. The company's losing $4 for every $1 of revenue it brings in. XHLD right now is just a binary betting slip, disconnected from a business that is, for all intents and purposes, technically insolvent.
You're conflating the long-term business viability with the immediate trade mechanics. But let's dig into that Lincoln Park situation and the V-Cube connection, because I think that's where the real disagreement lies. You're framing the V-Cube ownership as a pure liability.
It is the definition of a structural overhang. We need to unpack this deconsolidation strategy because it is the single most important driver of this stock's behavior. V-Cube, the Japanese parent company, owns about 60 to 70% of XHLD. Now, V-Cube is a major entity in Japan, subject to strict reporting standards. Because they own a controlling stake, they have to consolidate XHLD's losses onto their own books in Tokyo, and they hate that. It drags down their earnings and makes their own stock look worse. So, their stated goal, explicit in their filings, is deconsolidation.
Correct. They want to reduce their ownership percentage below 50% so they no longer have to report XHLD's losses as their own.
Exactly. But here is the crucial nuance that retail traders often miss. To lower your percentage ownership, you usually sell shares, right? But V-Cube isn't necessarily selling their shares to do this. Instead, they are forcing XHLD to issue new shares to third parties, like Lincoln Park, to dilute the V-Cube stake. Think of it like a pie. If V-Cube owns 60% of the pie, they aren't cutting a slice and selling it. They are baking a second pie and giving it to someone else. The total amount of pie increases, so V-Cube's percentage of the total drops. This aligns the parent company's interests with maximum dilution of the public shareholder. They want the share count to explode, so their percentage drops below that 50% threshold.
I see why you think that aligns them against the shareholder, but let me give you a different perspective. This is a survival strategy that could actually unlock value. If V-Cube succeeds in deconsolidating, XHLD becomes an independent entity. It stops being a tax write-off problem for a Japanese conglomerate and becomes a standalone target that could be acquired. The heavy hand of the parent company is removed.
Acquired by whom? With what assets? We'll get to the peer comparison in a moment, but the financing itself is toxic.
Regarding the financing, yes, the equity line of credit, the ELOC, is dilutive. I won't argue that. But it provides runway. Without it, they file Chapter 11 immediately. With it, they bridge the gap to this SaaS transition we're seeing with the Webinar.net partnership. It's a high-cost bridge, I grant you that, but if they cross it, the equity survives. The deconsolidation is actually the path to XHLD becoming a normal, tradable company again, rather than a subsidiary zombie.
That is an incredibly optimistic take on what is essentially a death spiral. Let's look at the mechanics of the Lincoln Park deal again, specifically the accelerated purchase clause. It isn't just about keeping the lights on. This clause allows XHLD to force Lincoln Park to buy up to 30% of the daily volume on days like Tuesday. The purchase price is set at roughly 97% of the market price.
Which is a standard discount for these types of alternative financing deals.
Standard, perhaps, but deadly. It functions as an arbitrage machine. Lincoln Park buys at 97 cents on the dollar and sells instantly at $1. They take that risk-free 3% spread over and over again. This creates a wall of supply. Every time the stock rallies, like it did on Tuesday, Lincoln Park is selling into that strength to lock in their spread. That kills the rally. And notice the agreement has a floor price of 25 cents. That tells you where the company thinks this could go. They have explicitly built a trapdoor down to a quarter.
That is their valuation anchor.
I'm not convinced that the selling pressure is insurmountable. If the demand is high enough, the wall of supply breaks. And that brings us to the market structure right now, specifically the squeeze mechanics. We have to talk about the float again, 3 million shares.
We keep coming back to that number, but does it justify a 123% move?
It absolutely dictates the physics of the price action. When you have a float that small and you have buying pressure, the order book thins out. You get price gaps, but it's not just the float. Look at the borrow rates. We're seeing rates around 27%. That's expensive for a short seller to hold a position. And there are snippets of data suggesting XHLD is nearing the reg show threshold list for fails to deliver.
Okay, for our listeners who aren't glued to the regulatory filings, what is the specific implication of Reg Show here?
It's significant. Reg SHO is a regulation designed to prevent abusive short selling. If a stock appears on the threshold list, it means there are a significant number of fails to deliver. Essentially, short sellers have sold stock they haven't located or delivered for 5 consecutive settlement days. If this persists, the regulation forces a buy-in. The broker is legally required to go into the market and buy the shares to close the trade, regardless of the price. If you get a forced buy-in event on a stock with only 3 million shares, that buying pressure hits a market with no supply. That is how you get a vertical squeeze disconnected from fundamentals.
That is the mechanical argument, but I worry about the psychological one. You mentioned earlier that the market is pricing in a binary outcome.
Yes, and I want to correlate this to the behavior we see on prediction markets like Polymarket. This is a trend we are seeing more and more. XMLD isn't trading on earnings multiples or revenue projections right now. It is trading like a binary prediction contract. Traders are betting yes or no on the event of January 28th. Yes, the deal flow conference brings a buyout or massive news, and the stock goes to $6 or $12. No, it's a dud and it goes to 50 cents. The behavior is identical to a binary option or a sports bet, and right now the volume tells me the crowd is betting yes.
It's fascinating that you draw a parallel to crypto markets and betting slips, but I worry that treating an equity like a betting slip ignores the underlying asset. We aren't betting on a horse race, we are buying a slice of a company. And this gamification of the ticker is dangerous. You're describing meme stock psychology. And frankly, some of this might just be ticker confusion with crypto tokens that also use the name 10. But let's look at who is actually on the other side of this bet. You mentioned the retail crowd betting yes. I'm looking at the dark pool data.
Institutional flows are always harder to parse, though.
But the data gives us clues. As of January 26, over 52% of the off-exchange volume, the dark pool volume, was short volume. Now, why do institutions use dark pools? To execute large trades without moving the market price immediately. The fact that the majority of this hidden volume is short tells me the smart money is fading this rally. They are selling into the retail buying frenzy because they know the dilution is coming. They understand the Lincoln Park deal. They aren't betting on a binary outcome. They are betting on the mathematical certainty of supply expansion. To ignore that dark pool data is to ignore the people who actually move the market.
Dark pool short volume can be interpreted in multiple ways, though. Sometimes it's market making, providing liquidity rather than taking a directional bet. But let's shift gears to what the company actually does, because you called them insolvent earlier. We need to compare them to the sector. If there is a squeeze, is there a business underneath to support the new price?
I'm glad you brought that up because a peer comparison is absolutely ruthless here. Let's look at a competitor like ON24, ticker ONT. They are in the same space, webinars, digital events. ON24 has something like $4.13 per share in cash. They trade at a negative enterprise value. If they liquidated today, you'd arguably make money just from the bank account. Now look at XHLD.
It's a different weight class, certainly.
It's a different universe. XHLD has negative equity. The debt-to-equity ratio is a staggering 134 times. They trade at a premium to their book value, which is negative. Even if you look at a distressed peer like Direct Digital, DRCT, they are generating $62 million in revenue. XHLD is doing less than $3 million annualized. There is no value floor here. If the speculation stops, there is no asset backstop, no cash pile, no real estate to catch the falling knife.
I'll grant you the ON24 comparison is stark. ON24 is a fortress balance sheet. But XHLD is trying to pivot. That's the strategic argument. Look at the webinar.net partnership announced in December. This is the cornerstone of their survival plan.
I looked at it closely. To me, it looks like surrender.
I would argue it looks like operational efficiency. They claim it will save them $1.2 to $1.7 million in operating expenses. For a company burning $700K a month, that is a lifeline. It effectively stops the bleeding. By integrating with webinar.net, they are upgrading their tech stack without the massive R&D cost. My argument is that the market is pricing in the value of the shell. If this partnership works, or if they sell the XVID Pro assets, the current valuation, roughly an $8 million market cap, isn't insane compared to the IPO price of $6 just a year ago. They are stripping the ship to make it float.
That IPO price of $6 is a memory, and referencing it feels like looking at a high water mark after a dam has burst. The webinar.net deal confirms my thesis. They are outsourcing the back end because they are broke. They can't afford to develop their own code anymore. And if you look at the revenue breakdown, their virtual hybrid segment, the tech part, was down 7.8% in the last quarter. The only thing growing was physical events. They are failing at the very thing they claim to be pivoting toward.
But that decline in the virtual segment is exactly why the partnership matters. It resets the cost basis. If they can stabilize the revenue while cutting $1.7 million in costs, they flip to cash flow positive or at least neutral very quickly. That changes the entire solvency conversation. They don't need to be Google, they just need to be self-sustaining to allow the stock price to recover.
You're assuming they have the time to let that play out. With $310K in the bank, they don't have quarters to demonstrate a turnaround. They have weeks.
Which brings us back to the Deal Flow Conference tomorrow. This is the stage. If the CEO, Randolph Wilson Jones III, gets up there and announces that the pivot is complete or that a buyer has been found for the VCube stake, the fundamentals you're citing won't matter for the next 48 hours. The low float will take over. The market pays for future potential, not just current balance sheets.
Or he gets up there, presents a standard slide deck about synergies and cost savings, and the market realizes there is no white knight. Then the Lincoln Park machine turns back on, the accelerated purchases kick in, and we flush down to that $1 NASDAQ compliance level or lower.
It is the classic standoff.
Let's wrap this up, because I think the risks are screaming here. XHLD is a trap. You have retail momentum driven by a conference, fighting against structural mathematical dilution from Lincoln Park and VCube. Every time the price goes up, the company prints new shares to sell into that rally. The house, which in this case is the financiers, has a massive edge. They are selling liquidity when you are buying dreams.
That's a compelling argument, but I would frame it differently. The risks are real, absolutely. But the low float mechanics create a window for asymmetric returns that you rarely see. If you are nimble, the lack of supply means that any positive news at this conference sends this stock vertical. We've seen it happen with similar setups where the float is this tight. If they solve the VCube issue, the price could reclaim the $3 to $6 range simply on a repricing of the float.
So it's a gamble?
It's a high-velocity trading vehicle. It's not a retirement holding.
At least we can agree on that.
Exactly. XHLD right now functions less like a stock and more like a binary option on the outcome of this January 28th conference. Whether you want to bet on the squeeze or heed the solvency warnings depends entirely on your risk tolerance.
And your willingness to hold a hot potato when the music stops.
Indeed. That's all we have time for today. Thanks for listening to The Debate.
Thank you for watching the video. Remember to subscribe to the Stock Market Palantir channel for more stock analysis like this, and leave your comments below. See ya.